Today, New Zealand's emerging property disaster. Hello again, it's Martin North from Digital Finance Analytics. I've noticed posts covering finance and property news with a distinctively Australian flavour. Well, of course, New Zealand is ahead of us insofar that they have put their official cash rate up to 2%. They lifted it 0.5% the other day. And we are seeing, therefore, things play out over there, which may play out here in Australia later. And as interest rates rise, mortgages get more expensive, and the property market is impacted. So today I want to look at some of the data relating to what's happening to the property market over there, and specifically trying to explore what it may mean. So there was a huge surge in the number of homes on the market, and it comes at the time when sales have plummeted across New Zealand. Property website realestate.co.nz had 26,301 residential dwellings available for sale at the end of May. Now that's up an amazing 77.6% compared to the end of May last year. The property portal, of course, spun the news along the lines of property seekers around the country now had significantly more choice in May than they did a year ago. And I guess you can hardly blame them. Vanessa Williams, the spokesperson for realestate.co.nz, said that with national stock at levels not seen this high since 2019, people are asking whether the demand for property will wane enough for us to see property prices reduce. Well, we'll see. The number of homes available for sale was more than double what it was a year ago in many regions, with the biggest increases occurring in the Wellington region, where stock levels were up by 188% compared to May last year, followed by the central North Island up 165%, Hawke's Bay up 148%, the Bay of Plenty at 143%, Nelson and Bays up 116%, Waikato at 106%. Interestingly though, new listings across the entire country in May were up only 2.5% compared to May 2021, and the increase in stock levels therefore is due entirely to a slowdown in sales. According to the Real Estate Institute of New Zealand, there were 4,860 residential properties sold in April this year. That's down 35% compared to April last year. And there are signs that the high number of properties on the market and low level of sales is indeed starting to affect asking prices. Average asking prices were lower in May than they were in April in 11 of realestate.co.nz's 18 sales districts. The biggest declines in average asking prices were in Waikato, when they were down 15.5% in May compared to April, followed by Gisborne down 9.2%, Hawke's Bay down 5.9%, and Southland down 5.8%. And of course, the portal once again gives this a bit of a spin. Without a crystal ball, we can only look at what has happened in the past. And if we look back to 2019, average asking prices continue to increase despite stock fluctuations, Vanessa said. Month on month, average asking prices have been declining nationally since February 2022, but Vanessa says that property is still in high demand. We may not see the dramatic price drops that some have speculated. Immigration into New Zealand is currently at an all-time high. It has been reported that by the end of 2022, more new residents will enter the country than any other year on record, she said. This will likely mean that demand will rise. And Vanessa added that new residents often bring capital to buy homes. During May, the highest number of overseas users to realestate.co.nz were from Australia, England, and the USA. There are many factors impacting the property market right now, from rapid inflation and interest rate hikes to housing intensification on the horizon, thanks to the RMA Amendment Act, said Vanessa. For potential buyers, the increase in stock levels and easing in asking prices is obviously good news. And with so much stock to choose from, they can afford to take their time and negotiate hard to get a good deal. For vendors, the market has become more difficult, and they will need to pay particular attention to having their properties well presented and realistically priced to ensure a sale over the coming months. Now, there are about 11,552 more homes available for sale nationally than in May last year. And property seekers are more likely to find their dream homes this winter, with stock up 77.6% year over year nationally. Though, of course, she did blame seasonal factors, which she said could explain part of this, with many vendors battling down the hatches in winter. But she said it could also signal that the increasing stock levels that we've seen during 2022 aren't here to stay. There were 15-year record high average asking prices in Canterbury and Central Otago and Lakes District. And compared to 2021, asking prices were up nationally and in all realestate.co.nz's 19 regions last month. The South Island came out on the top during May, with record average asking prices of $738,241 New Zealand dollars in Canterbury. That's up 28.8% year over year, and $1,456,348 in the Central Otago Lakes District, up 27.7% year over year. And month on month, however, prices did decline in 11 regions and by more than 5% in 4 regions, with Waikato down 15.5% to $850,381, Gisborne down 9.2% to $699,979, Hawke's Bay down 5.9% to $842,245, and Southland down 5.8% to $496,612. Nationally, and in Wellington, West Coast, and elsewhere, average asking prices remain stable. And Vanessa says that the decrease in the Waikato region last month is likely a correction of April's price surge, when the region's average asking price breached $1 million. And she said Auckland and Wellington remain in buyer's market territory. Other regions show signs of tipping, and major census markets have favoured buyers for several months, driven by increases in stock levels and the slowing rate of sale. For the second month in a row, Hawke's Bay and Otago continues, she said, to show signs of tipping into a buyer's market in May. Wellington's been a strong buyer's market for 3 months now, which we can count as a trend, so it'll be interesting to see whether those regions eventually follow. And in addition, the gap between the current rate of sale and the long-term average is also starting to close nationally in May. And Vanessa said this could signal a national buyer's market on the horizon. Now, ANZ, in their May Property Outlook forecast, that the REINZ House Price Index will trough 28.3% above its pre-pandemic Q4 2019 level. And the Reserve Bank of New Zealand's forecast would see the CoreLogic House Price Index trough 32% above its pre-pandemic level. And the Treasury's forecast could see the CoreLogic House Price Index trough 36.4% above its pre-pandemic level. And one of the most interesting statements in the report was that demand will ease back and supply will catch up. And that suggests that the construction sector, which is already stretched thanks to rising costs of materials and labour, will see a shortage of tradies, and so we'll see residential construction potentially slow abruptly. In fact, while building consents have been elevated, a sharp downturn would be consistent with what businesses are saying. And they also say that the recently announced higher caps on first home buyer grants will add to housing demand, but they think this is likely to have indistinguishable impacts on house prices over the year ahead, given how far prices have already moved relative to caps, meaning that the increase may not bring that many additional homes into the fold for first-home buyers, and secondly, where general housing momentum is heading right now, with debt servicing costs increasingly a constraint on would-be first-home buyers, as well as house price falls. And they've also tweaked their official cash rate forecast to be slightly more front-loaded. They continue to expect a peak at 3.5%. They have also centralised some of the downside risks that they still see, and they do admit it's all very uncertain. They now expect house prices to fall 11% in 2022, previously down 10%, with a much soggier recovery thereafter. And if you want another point of view, although in the same territory, worth listening to what the ASB has just said. Thump, they said. That's the sound of Kiwis' house price expectations crashing back down to earth. That was the opening comment in ASB's report on the bank's latest housing confidence survey. We openly fretted about house price overconfidence last year, but the abrupt turning of the housing cycle has put paid to all that, the report says. The latest survey, which was taken over the 3 months from February to April this year, showed a net 11% of people expect house prices to keep rising, down from a net 49% in the previous 3 months. The surprise, if anything, is that they didn't have expectations that prices will fall even further. The report said house prices have already fallen around 5% from the November peaks, and we reckon the slow leak of pressure out of the housing market has got at least another 12 months to run. 3 big housing nasties are there: higher mortgage interest rates, tighter credit conditions, and increased supply, and they are all now playing out and are set to stick around. Interestingly, it was survey response in Auckland who are most likely to think house prices are going to keep rising, with a net 15% in the city of sales believing house prices will keep rising, compared to 8% in the rest of the North Island, 11% in Canterbury, and 7% in the rest of the South Island. Aucklanders also appear to be less likely to think that interest rates will continue to increase, although an overwhelming majority think they will do so. A net 77% of Aucklanders think interest rates will increase, compared to 83% in the rest of the North Island, 80% in Canterbury, and 82% in the rest of the South Island. Overall, a net 81% of survey respondents thought interest rates will keep rising, up from 77% in the previous 3 months. So whether you look at sentiment, whether you look at price data, stock data, or indeed interest rates, all of the indicators are turning a nasty shade of red. So I guess the points to make here is that as interest rates rise, momentum changes in the property market. And now, of course, the speculation is to what extent will property prices fall. Most economists in New Zealand are definitely forecasting significant falls, at least 10%, maybe more. And as to the OCR, well, it's going to go higher. The question is, how high will it go and how long will it stay there? But the takeout definitely is that the markets have turned, and it does take time for all the various factors to feed through. So, for example, if you lift interest rates, you don't necessarily expect to see property prices immediately responding the following month. There may be some change in sentiment immediately, but it does take time for it to percolate through the system. So coming back to Australia, with our official cash rate likely to rise next week, we can expect more downside pressure on properties in Australia too. And to an extent, we'll probably follow what New Zealand has already been doing. But I also want to underscore again how the property portals are able to magically spin the story to turn a negative into a positive. More supply, she says. More supply. Well, there will be more supply in Australia too. We're already seeing it. But of course, just because more property is listed doesn't necessarily mean that more buyers are going to come out. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.